Hi, Dr. Dolly. This is Steve from Michigan again. I've often heard you talk about tax loss harvesting, but I don't know if that is the correct decision for me. I've recently started a taxable account after maxing out my Roth and deferred accounts. The date today is March 23rd of 2020, which means that account is deep in the red. I feel like my risk tolerance is pretty good right now because the only thing I can think about is buying more of these securities to lower my cost basis and increase my yield on cost. Why would I sell right now and realize those losses? Am I thinking about this all wrong?
Okay, Steve is missing the point of tax loss harvesting here. Yes, you should tax loss harvest your brand new taxable account. In fact, tax loss harvesting is almost always done on stuff you bought not that long ago. And the reason why is because the stuff you have the biggest losses on tends to be stuff that you bought recently. If you bought it 15 years ago, you're probably not underwater on it. So why would you sell and realize those losses? Well, the reason why is so you can claim those losses on your taxes. You can use them to offset capital gains in any amount. You can also use them to offset up to $3,000 a year of ordinary income. And then, of course, those losses are carried forward if you don't use them all up in any given year. But what you are missing here, Steve, is that at the same time you are selling, you are buying a very similar investment. And so you're not actually selling low. You're still in the market. You basically still own the same investment, not exactly the same, but very, very similar. And so you haven't sold low. All you've done is harvested or captured that loss. And that becomes even more valuable if you have a method of flushing capital gains out of the portfolio later. For example, we give a lot of money to charity. So instead of giving cash, we give appreciated shares. So I harvest the losses, I flush the gains out as our capital, as our charitable giving, and those gains are never realized. So we basically don't pay capital gains taxes, but we can take advantage of those losses on our taxes each year. Another way you can flush them out of your account is just by holding on to them until you die. And then your heirs benefit from the step up in basis at death. But combining, a method of flushing out the capital gains along with tax loss harvesting can be very powerful and can make a taxable account really rival a tax protected account in a lot of ways. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.